That's crazy.
Yeah, yeah,
So,
people don't realize it goes just like that. So get involved in your 401k.
yep.
Get involved in saving money in your IRAs. Don't listen, if your financial castle is built, like you're out of debt, you're saving enough money, you have somebody that you've worked with that knows how much money you need to save. If your plan is in place, then you can have fun and spend money. And I'm not saying don't spend money because you'll go crazy, but the deal is don't spend foolishly when your plan is not in place.
Yeah.
Because you can get your plan in place, whatever that plan is, and then feel better, because then you won't feel guilty about spending that money if your plan is in place. And I think the biggest thing is people don't want to they don't want to ask somebody, and maybe I don't know how to phrase this, but I'm going to phrase it. You don't want to look dumb, but in reality it's not looking dumb. It's just you don't know the information yet, and somebody else does. Yep. It's okay to ask. It's okay to go, I'm in debt up to my eyeballs. I don't have anything saved. You know what? We all got to start somewhere.
Right.
I don't care if you're 40 and you're in that situation. Don't be embarrassed. Just get some help.
Yeah.
Welcome to the Analytical Rewired, the best place to discuss various obstacles, limitations, challenges, behaviors, and how to overcome them in business. We deep dive into the complexities of people, processes, data, and technology, PPDT, adopting our focus to be either technical or creative expressions, and how to balance the two. The Analytical Rewired is brought to you by the MJW Group, a performance improvement and leadership development boutique management consulting firm that helps companies save time and money leveraging operational excellence. Our mission is to enable your organization to be more successful by refining overarching strategies into detailed plans to be implemented, generate creative and technical solutions for your operational challenges, augment and supplement your existing teams, and help you create processes that allow you to be more efficient with the resources you have. You can learn more about the MJW Group on our website at themjwgrp.com.
Welcome to the Analytical Rewired. I'm your host, Jennifer White, CEO of the MJW Group, and I have my co-host with me, Sarah. How are you?
I'm good. How are you?
I'm doing well. I'm excited about today's guest. He's been in our world for a little while now, and I don't know if it's a good thing or a bad thing. He can be the judge of that. But let's welcome Robert Henriques to the show. How are you?
Hey, thanks for having me. I really appreciate it. Really appreciate it. I'm excited about being on the podcast.
Yeah, we're excited to have you here today as well. And what we're going to be talking about, retirement plans and investments. It's something that's, I don't know, I'm a nerd when it comes to these things. Like, I geek out about it. And I actually like all of the thick manuals and reading about it and learning more about the topic. But Robert, let everyone know who you are and what do you do?
Yes, thank you. Yeah, you're definitely one of the few that likes reading big manuals, but normally people use those to go to sleep, but especially in the investment world. But anyway, yeah, I've been a financial advisor now for 28 years, and I started when I was 5. No, I'm just kidding. I got out of the military. I was on nuclear powered submarines, and then got into the financial advisory world because my mom was also in the field. And I just really thoroughly enjoyed helping people. When I ran into the business of helping people understand finance, because I believe that we should have been taught in school about money. It's such a big part of our lives that drives our emotions. If we are broke, we are not happy. That's just the way it is. And it makes things more difficult. And I think there just needs to be more education on the field. And so that's really where I come in, but I really wish they would put it in schools more.
Agreed.
I know that we have it in schools, but we don't have it to the degree that we need it, in my opinion. And so many people.
Let's just be honest. It's not in school. Everything I know about money now this is my third education, and I'm only 7 years in.
Yeah, and you know what the deal is if you type it on the internet, and the internet didn't really fix it, because if you type in IRA, for example, individual retirement account, in the Google search, it's going to come up with 3 million different views on what an IRA is. So it's very hard to disseminate information of what's real and what's not on the internet. So the internet almost made it worse and didn't make it better. But anyway, that's what my passion is. I love helping people. And I love to see that light bulb go off when somebody starts to get like compound interest, the rule of 72, things of that nature. It's just cool to see. And I really, even today, I've been in the business for 28 years, and I'm just as passionate today as I was when I started. And I was a passionate guy. I read every book I could get my hands on, from insurance to investments. I read everything, just because I was flabbergasted that I was never taught this information myself. Yeah. And I was doing everything bad. I wasn't perfect. I had credit card debt. I had everything that everybody else had. I had, until I learned there was a better way.
I wish it was in college, honestly, because I feel like that's where a lot of kind of financial mistakes start, just because, at least this when it happened for me. I opened a credit card and I was just really stupid with it. And I think I put a trip to the Bahamas on it. And I was like, well, I'll pay it back when I can. And
all I do is swipe.
And it took me forever just to get my credit back on track from that. And it's like insane to me how it's one of the most important things. Like, credits run for so many different things, and no one really tells you how to fix it.
And they allow those people to the credit card companies to put tables on college campuses and allow students to sign up for that stuff. It's just I don't get it. But that's how you probably got your
incredibly high credit limit to somebody that doesn't even have initial credit to begin with. I think they gave me a $4,400 credit limit, and I thought I was a new woman. I was like, I'm gonna get my hair done. I'm gonna go to the Bahamas.
I had a friend of mine that was in college, and he got credit cards that said household income. When he was Cuban, so his grandmother lived there, his grandfather lived there, his mom lived there, his dad. So he put the whole household income, and they gave him like $50,000 on a credit card.
Insane.
They're
like, oh, okay, here you go.
It's just crazy, but that's where most people get started early in life and start making those mistakes.
Yeah. So Rob, you say you have a passion for helping people, but what is it about personal finance that really, coming out of the Navy, what was it that really drew you to that type of work?
Well, like my mom was in the business, and so she introduced me to it. And then when she sat down with me and showed me the concepts of compound interest, IRAs, 401ks, remember I was taken back by the information. And so that's where I gained my passion from, was really my mom. And my mom's been in the business now for 30 years. So I just followed her footsteps.
Yeah, that compound interest, it's the eighth wonder of the world.
It is. That's a fact. And you know what? The people that are watching this video may or may not even know what we're talking about with compound interest. But I'll tell you, if you're hearing this video, go look it up.
You don't? Okay.
I mean, I know what it is. Like, I know the basics, but for real, I really don't. I don't know much about it. If you take 1% and divide it into 72, the answer is 72. The answer is that's how many years it takes your money to double at 1%.
72 years. So if you take the 3 and divide it into 72, that's 24. It takes 24 years for your money to double at 3%. So all you need to do is take the number, and it sort of gets skewed at after 18%. But if you take 12 and divide it into 72, the answer is 6. Every 6 years, your money doubles.
Okay.
And it's unbelievable, the exponential growth on money and how it works, but it's definitely something to look up.
Yeah, it was interesting to me. I remember when I was in college, in my first internship, and some of the engineers at the company I was interning for, they told me, please don't work here. Go do something else with your life. But they showed me this chart. I'll never forget this chart of, it was like life expectancy of when you retire. Like after you retire, like how much life goes downhill. And I was like, why are you showing me this? But they were trying to tell me, like, do everything that you can to like get yourself situated like in your 20s with putting money away for retirement. So by the time you get to my age, you won't have like a short expectancy of your life of when you can have fun and play and do all these things. That's why they were showing me that chart. And now we have more. This was like a funny chart they were showing me, but now we have detailed charts that show us the facts and the statistical history of the younger you are with being mindful of money and really, utilizing it as a tool for your benefit, the faster you can get to doing the things that you really want to do.
Yeah, that's absolutely 100% true. And so it used to be where you got a job and the job offered a pension, and they offered, and then Social Security was guaranteed. And so if you and most people back then paid off their houses. They lived in the same house that they got married in, and they didn't upgrade to the new $500,000 house. And so they retired with pension, Social Security, and they were pretty good savers back then. So retirement was inevitable. Now pensions have gone away, and I'm not going to get into all the reasons why, but Social Security is, there's not a lot of people that have a lot of confidence in Social Security anymore as well. So it's all into your own savings. And that's why the education in school is so important, because IRAs, 401ks is really how you're going to get there, unless you have some other means that you know about. And that
inheritance.
What'd you say? Inheritance.
Inheritance.
Yeah, you know what? Hey, Jennifer, you know what inheritance
my parents
is?
Don't see this.
You know what inheritance is for most people is they're going to inherit debt.
That's true too.
They're going to owe money. So yeah, that's most people's inheritance. But anyway, so the path is very unclear, and so people don't realize that $1 million saved. If you save $1 million, that's going to be about $50,000 to $60,000 a year in income, in interest income. So your $1 million doesn't deplete. So because you got to keep that $1 million intact, because it needs to keep paying you. So all you can draw per year is about $50,000 to $60,000 a year, which is about 5 or 6%, and to keep that $1 million intact. So think about what the cost of living is going to be when you, Sarah, you and Jennifer are at retirement. I mean, there is no better, in the last couple of years with inflation, people are, look at it. It's just unbelievable.
Right. And I think some goes back to, I think anything with personal finance, like it's a mindset shift. And that's why I was saying earlier, like I consider myself 7 years old, because I had to relearn and deprogram everything that I thought I knew about money and come to terms, and just like, we had to like just break even at net zero and just start over literally 7 years ago. And my mindset around money is just so, it's just totally different now. And I realized like time is really, really on your side when you're younger. It's always on your side, but it's so much better when you're younger. Like you're saying, if we were taught these things in school at a younger age, and not make some of the same mistakes, or maybe we just didn't have the financial literacy that others get, at certain schools, perhaps. But utilizing what I know now. If I knew that like back in 2005, wait, when I started working in 2003, I think it was like my first real job. If I would have knew that back then, I mean, that was 20 years ago already. That's crazy.
Yeah.
So
people don't realize it goes just like that. So get involved in your 401k.
Yep.
Get involved in saving money in your IRAs. Don't overspend listen, if your financial castle is built, like you're out of debt, you're saving enough money, you have somebody that you've worked with that knows how much money you need to save. If your plan is in place, then you can have fun and spend money. And I'm not saying don't spend money because you'll go crazy, but the deal is don't spend foolishly when your plan is not in place.
Yeah.
Because you can get your plan in place, whatever that plan is, and then feel better, because then you won't feel guilty about spending that money if your plan is in place. And I think the biggest thing is people don't want to they don't want to ask somebody, and maybe I don't know how to phrase this, but I'm going to phrase it. You don't want to look dumb, but in reality it's not looking dumb. It's just you don't know the information yet, and somebody else does. Yep. It's okay to ask. Mm-hmm. It's okay to go, I'm in debt up to my eyeballs. I don't have anything saved. You know what? We all got to start somewhere.
Right.
I don't care if you're 40 and you're in that situation. Don't be embarrassed. Just get some help.
Mm-hmm. Yeah. Why do you think we get, because we've all been there. Like we get money, we just want to spend it, or we see something we really want it. Like,
because it's so much fun.
Why do we? But then we're like, fun. We have all this junk. I don't have any space. I keep saying I want to buy a what do you call the public storage?
Yeah, the shipping container or something.
They keep building them around here. And I'm just like, how many storage how many can people have?
Yeah, it's just America has more junk, I think, than any nation on earth, really. Because you're right, everybody. I'm serious. I mean, we should open a shipping or a storage unit, because they're always full. They open them, they're full. Mm-hmm. That's what people do. We're consumers.
That's what it is.
But you know what? Don't be part of the crowd. Don't be part of the crowd. I mean, you can buy stuff, of course, for yourself, but don't overbuy.
I'm trying to break that as being in retail or in fashion for a decade. I have a lot of clothes.
I'm married. I've been married for a long time. I get it. Clothes are important.
I have a lot of clothes. I'm a collector, a purveyor of clothing. So I need to break that habit.
I know it's a sport.
It is.
I get it. Definitely.
Awesome. So how have you seen your industry kind of shift over the last few years, especially with the pandemic? And obviously quite a bit has changed over the last couple of years. So I'm just interested.
Where do we start? Do we have enough time?
I know. I'm like, that's a hard one to dive into. But once again, it's that one's, it's just very interesting to me, especially.
Oh my goodness.
I mean, my boyfriend has a portfolio with his stocks and whatnot, and he's like, it got depleted like almost 20 grand over the last couple of years. And he's like, it'd be nice to see that again. To see my 20 grand back.
Few months.
Yeah.
But you know what? The good thing about being young and your portfolio, because you didn't really lose it unless you sell. Because when the market's down, that doesn't mean that, let's use Apple, for example, just because the market's down and Apple's stock price is down, that doesn't mean Apple's not a good company or not selling as many phones. That just means, what happens when the market goes down, people run from the market versus running towards the market. And that's really what people should be doing. I use the example of Kmart. I know you guys may be too young to know.
I love Kmart. I remember Kmart.
That was my
right. So remember, hey, do you remember the blue light special?
Yes.
Mm-hmm.
Right. So they push the blue light, let's say, into the women's shoe section. And then all the women run over there and buy shoes. And so you take that same blue light and push it on the market floor, and everything goes on sale on the stock market, and everybody runs from it versus running to it. And especially if you're young, that's an opportunity to buy.
Yeah.
An opportunity to take advantage. And we're in the best times right now, especially of the last 2 years for you youngsters to be able to dollar cost average. Dollar cost average, meaning that you're putting in money every single month, not worrying about what the market's doing, not worrying about anything. What you're doing is every single month when you get paid, a portion of your check is going into either your IRA, your 401k, or something like that. And you don't care what's going on. The market's higher, the market's low, but you're averaging the cost of that stuff. And so you really want to see those downturns. I mean, because that's when you can buy stuff at such a great price. But, you know, back to your question, Sarah, we have seen a lot of change from a standpoint of, we've been through, you know, who would have ever seen COVID? I mean, we've never seen that in our lifetimes. And we went through that, and the market really fell off a cliff, but came back pretty strong a couple of years later. And now we're going through with inflation and the Fed's raising rates and gas prices and all that. So we've had a really, really rocky time, which rocky times should be only, you should really only worry about those if you're within your 5-year or 7-year retirement window. For you guys that are not in that window, just keep plowing away. Find a way to put more money in during these times, because I'll tell you, we're going to run into a bull market, which is a market that's trending upwards, and we'll get out of this mess that we're in, and then prices will start to go up, and now you're buying stuff at a higher price. So, but another point to that as well is we've seen a lot more people being able to use the tool that we're using right now. Even older folks. I Zoom with most of my clients. Zoom. I mean, I have 70-year-olds, 75-year-olds that jump on Zoom with me, which is pretty cool.
That is cool.
But they don't have a printer or a fax machine, but they can get on Zoom.
Yeah.
So. It's all right. I don't have a printer or a fax machine either.
There you go. Maybe you're just an old soul then.
Maybe.
But anyway, yeah. So, but I believe that we're on the tail end of this. We may have a little bit of rocky start in 2023 as we continue through, but we're on our way out of this from a standpoint of what we've just been through.
Yeah, I'm excited for all the change. I don't know. I'm not a gatekeeper or a resistor of how things were in the past. Like, I like to move forward. My mom always taught me, like, you never go backwards. Like, you don't look back, don't turn around. Like, you keep keep moving forward. So I'm always one, like, let's do it. Let's change up what we're doing. Let's do something different. Let's go into the unknown and travel down the road less traveled. I'm always for that. And I just love everything that we've been able to witness for the last 3 years and to be a part of it. Because we've been using Zoom since 2016. But it seems like it wasn't until 2020. Nobody knew what Zoom was.
Nobody really knew.
Like, what?
I mean, we would try to do it, but yeah, nobody knew really what to do or how to do it.
Mm-hmm. Or just even yesterday, I ordered a meal kit last week, and thank goodness I did, because I was sick this week, so I couldn't go to the grocery store. And the meal kit came to the house. It's like 4 different meals in there. I was like, who would have ever thought? And then my husband ordered from Costco the other week, and I was like, you really don't need to leave the house, and you really don't need a car.
In this day and age, you don't need to leave the house. I mean, everything can be delivered to your doorstep. It's crazy.
Yeah. So all that innovation and those shifts, like, I'm just glad to see it, even in your industry, how we can buy, like, at the fingertips. I can go on here and go to my brokerage and swap, trade, do whatever I need to do. I can text Rob with any questions I have. Like, everything is like instant at a point of use.
Yeah. It has been a pretty crazy change in our world in the last 5 years.
Yeah, exactly.
The way things are done,
Mm-hmm.
So. But anyway, yeah, just get your plan in place and save your money. You can't do it soon enough. Because, you know, there's another thing that we say, which is time value of money.
Mm-hmm.
So it's all about time, and it's all about discipline. Mm-hmm. Investing is not as much about picking a certain portfolio as it is about discipline of doing it every month.
Trick question, Rob.
Got it.
What about these people that's still holding this money underneath their mattress, and they're just, one day we're just gonna need it, you know? I'm going to need these dollar bills from 1948. I know I'm gonna need them. So what do you have to say about that?
Well, it really depends. I use the 3-bucket system when somebody has money, and I tell them to categorize those funds into 3 buckets. Well, the first bucket is your checking account, because you know it gets 0% interest. So therefore, with inflation being regularly 3%, but right now 6 or 7%, you're losing money as it's under the mattress, or even losing money when it's sitting in your checking account. So that's your first bucket. That's immediate need: groceries, gas, house payment, those kind of. The second bucket is your 3 to 5 year bucket, which is your intermediate bucket, money that you're saving for a house, money you're saving for a down payment on a car that you know that you're going to be using in the next 3 to 5 years. But because you don't want that money in the market, you want that money more in a money market account. What'd you say, Jennifer?
A high yield?
A high yield money market account. Even right now, and this is not Robert normal, okay? But even right now, the possibility of using a CD for those possibilities, a 1-year CD, because you can see rates now right now about 4% on CDs. That the possibility of that for a 3 to 5 year money, and then you have your last bucket, which is your long-term bucket, which is your retirement bucket that you should be yielding, hopefully in the 10 to 12% range over a period of time. People, oh, it's not 12% this year. I'm talking about over a period of time. And that's your long-term retirement money in your 401k. So if you have money under the mattress, first things first is classify that money and what it's going to be used for.
I like that.
Yeah. So once you figure that out, then we can figure out your buckets.
Yeah, I like that. So every dollar should have an intent.
Yeah.
Correct. Absolutely. Some people, you know, they get inheritance or a death claim or something. That's really what we tell them. The first thing to do is write down the buckets and put money in there. Mm-hmm. And we'll go from there. And then after we figure out the buckets, we'll figure out the vehicles in which we're going to use to accomplish that goal.
I grew up with my mom putting her cash in a coffee cup in the cupboard.
Hey,
she was like, this way I don't spend it.
You know,
that's what I grew up with, and she still to this day does it. And I actually found I tried to do it too, and I was like, wow, I really don't spend it because I forget that it's in there sometimes.
You know what? I have so many clients that say, I have it in a safe, I have it under a mattress, I have it here, have it there. If it's just the apocalypse money, you know, where the zombies are coming,
money.
I get you, okay. But if you're saving that money under your mattress for retirement, let's have a conversation.
Yeah.
No, I think that was her fun money. She was just like, I just don't want to touch it right now. So
yeah, see, she was planning on using it though.
Yeah,
she just didn't know what for.
Yeah.
Yeah, so well, we do that all the time. Older folks pass away or whatever. We find stuff everywhere. I mean, they bury that stuff. I mean, they have maps,
coins, stamps.
I mean, you know, those I-bonds. The I-bonds that they used to buy, the government bonds.
Yeah,
I've seen $250,000 in bonds.
Those are making a comeback right now, though.
They have stacks of rubber bands around them.
That's funny.
Yeah, so they save their money. That's what they knew. And you know what? A lot of things, though, you remember those guys. A lot of those folks that are passed away, they were right after the Great Depression. I mean, that was, you know, whether they're born in 40, 44, 30. I mean, they heard that stuff from their parents, so they were definitely a different generation when it comes to money.
Yeah,
Definitely a different generation.
So, Rob, let's talk about small business investing. So, if there's a business owner that's listening, what avenues or what are some vehicles they can utilize as they're starting to generate more business income, right? Which is ultimately the profits from the business. How can they utilize those funds to really set themselves up in their retirement plans? Because it's a little bit of a different ball game when you're not working for a corporation or a company that offers these things to you, and you're picking, right? When you own your own business, you have to make that decision. You have to put these things in place. So what are some vehicles that are available?
Yeah, absolutely. That's a great question. Yeah, because you're trying to build a business, and then it comes along, then you got to figure out how to save and where to save and what's the best vehicle for you to save in. So really, there's four that are predominant from a standpoint of savings, all the way from a sole proprietor all the way up to a business that has greater than 100 employees. The first one is a SEP, okay, which is simplified employee pension. And that's really for a sole proprietor. The reason I say that is because if you put in $20,000 this year for yourself in your SEP, and let me just explain SEP. We also in the industry call it an IRA. It's a SEP IRA. So IRA stands for Individual Retirement Account, and it's very similar. The rules, if you know the rules of 401ks, the 59.5 rule, the 72 rule, meaning you can't take your money, you have to take your money out after, start taking it out before 72, RMD rules, which are mandatory distribution. All these rules in these plans are virtually the same. Okay. So the IRA or the SEP IRA, let's say you put in $20,000 for yourself and you do have a secretary, then you're obligated to do the same thing for that person as you are for yourself. So those are the reasons. Can you have a SEP and have employees? Yes, but know that you're going to put in the same exact dollars for them as you do for yourself. And a lot of times that's not what a lot of people want. That's why we usually say it's for people that are self-employed and don't have any employees. Because here's the deal. You can put up to $66,000 a year away tax deferred in that SEP. In an IRA, like a Roth IRA, a standard, if you came to me and did a Roth IRA, which is a tax-free retirement account, you can only put away $6,000 or $7,000 a year, depending on your age and some other circumstances. So SEP is a great way to put away a good amount of money. If you're making a good amount of money, you can put it away. But there are rules on that. You know, for example, 25% or 66,000, whichever comes first, right? So if you make $2 million a year, you're not going to be putting away 25% of that. It's 66,000. So there are some rules on that, and there's some rules on deductibility, which we can't get into all those details today because they're quite extensive, and I don't want to take. We'll be here for till tomorrow if I go into those rules. But I want you to realize too is you invest those dollars. When you invest them, you're investing them in mutual funds, ETFs, stocks. So they're gonna grow. The SEP IRA is just an umbrella. Okay, and let me move through quickly so I don't take too much time. The next one is solo 401k. Those are for people that have no employees. You cannot have employees and have a solo 401k. You can put upwards of $61,000 in your solo 401k, or $67,500 if you're over 50 like me. And there are some profit sharings in the solo 401k that you can do for yourself and things of that nature. The only requirement on a solo 401k is that you have an EIN. Okay. And then if you do, so those two, the SEP IRA and the solo 401k are really for people who are sole proprietors. Even though you can use them for other things as well, but primarily that. The next step up is the simple IRA. That's for people who have companies with less than 100 employees. Now, I'm going to say something about that in just a minute, okay? but let me just go through this. Simple IRA stands for Savings Incentive Match Plan for Employees. And what it does is it gives the small business employer the ability to have flexibility in matching. Because they're in the beginning years, they can have lulls in their profits. So it gives them the ability to not match or match at a lower percentage in those lean years.
Mm-hmm.
Okay. So for, I think 2 out of the 5 years, you can match down to 1%.
Mm-hmm.
And that's of the employer's choosing. Or you can choose to do 2% for all employees. So there's all kinds of flexibility, but they're made for small employers. Now, with that said, I want to say this. The regular standard 401k used to be much more expensive to operate. Now with all the technology that we have, regular 401ks, because we are setting them up for smaller businesses now, because they're very cost effective and very well managed. If you have a simple IRA, you're really doing all the accounting yourself as a small business. If you have a 401k, then a lot of the accounting is done by the third party firm. And Jennifer probably could talk to that as well, since MJW Group has a great 401k. But in the 401k, you can save up to, by the way, these are important rules. You can save up to $66,000. Now, people don't realize. I had a client the other day I had to let know. He thought he was fully with his match. He thought he could only put in 22.5, which is the 2023 rules. Mm-hmm. No, you get to put in 22.5, and then the company can put over the matching, and you're not going to go over because you can go up to 66,000. So you can put in the 22.5. He thought that he had to stay below the 22.5, and then the employer match came up to the 22.5. That's not the case. You can put in 22.5, and then if the employer does other things, you can go up to 66,000 on the 401ks. And most of those, by the way, have catch-up rules, meaning for people that are over 50, they allow to have money put in that is in excess of what somebody under 50 could do based on them being behind. That's the whole purpose of that, right? So the reason for these rules, or the reason for these plans, are tax purposes. They allow you to have tax deductions. They allow you to grow your money tax deferred. So therefore, if it grows tax deferred, you get compound interest on the tax deferred dollars rather than paying them out to the government.
Those are good options. I mean,
yeah, they are. They're great options for small sole proprietor all the way up to a regular business or business that has 100 employees or more.
Yeah, and again, I think it's being able to reach out to someone like Rob, who's a professional, to walk you through those options that he's talking about if you don't understand them, because I didn't understand them at first, probably earlier. Oh God, it was last year now, a whole year ago. And Rob, he explained it to Marcus and myself what all these options meant, because it was a whole new world for us, being 5 years in 2022. We were like, okay, we need to pick this back up again. So where do we start?
Yeah, because people are so busy with their jobs. They're good at what they do. They're good at what they do. They can't be good at everything. So lean on somebody, that might know. That doesn't mean you have to do it. Just get the information, make a decision for you and your family, and whatever works best for you guys.
Mm-hmm.
Yeah.
Oh wow, you dropped a lot of bombs.
I know, and I probably
good bombs.
I went into stuff that people may, if they watch the podcast, like, I don't understand that. Well, reach out and feel free to call me.
Yeah, exactly. So how can people reach out to you, Rob?
What's the best way?
You tell us.
You
I don't know the rules.
I'll put it in the show notes.
What'd you say, Sarah?
I said, I'll put them in the show notes.
Okay, so I don't need to tell, do I need to tell my phone number here?
Sure, go for
it. If you don't want to.
I don't know.
Go ahead, Rob. Go ahead.
Okay.
We know.
My number is 678-516-7576. Feel free to call me with good intentions.
Oh, Rob, a good question. Can you help anyone in any state, or are you only licensed to help in specific states?
Anyone in any state for the most part.
Good.
Yeah.
Awesome.
Everywhere around the United States and Alaska.
We always forget about them out there.
They're just around there floating around.
All right. Thanks, Rob, so much for being on the podcast today. Are there any last minute tips or parting gifts you want to leave for the audience?
I would say don't get too caught. Listen, if I was to drive to Jennifer's house in North Carolina, right? I wouldn't tell Jennifer when I got there that I drove, how many inches I drove. I would tell her how many, if she asked me, I'd tell her how many miles I drove. Mm-hmm. It's the same thing when you're looking at your portfolio. Don't look at it every single day. This is the long haul. Okay. Don't get too caught up in the ups and downs on a daily basis. All that is just a bunch of noise, either coming out of Washington or coming out of the feds or coming out. Listen, build a portfolio that you're confident in, that you know that you've been through with somebody, that you feel good about your portfolio, and let it go. The only time you should worry about it is when you get closer towards retirement. Okay.
Another bar.
Don't get too caught up in the daily activities of what's going on. Oh, it's up, it's down. I lost 10, I lost 15. Listen, keep plowing money in. Keep plowing money in. And one day you'll be excited that you did.
Another bar. Sarah, let's recap. Step 1, put your money in buckets. Step 2, what are we doing with that money in the buckets?
We're putting it in a compound interest, something about an IRA. Maybe I need to call you Rob.
Hey, Sarah,
we're defining what the buckets are. We're defining what the buckets are.
We're defining what the buckets are.
Step 3, we're putting them in the vehicle. Step 4, we dollar cost average. Step 5, stop watching the news and live your life. Okay,
that's a good one. I started doing that a long time ago.
Congrats. Good job. Good job. And get out of debt. Get out of debt.
That was step 0.
Yeah. Get out of debt.
Get started with that one.
We could do this. We could do this once a month and have all kinds of new stuff every time.
Yeah, let's do it. Why not?
Hey, you guys have a wonderful, wonderful weekend and enjoy your family. And
Rob, I have to close us out.
Oh, I'm sorry. Go ahead.
We're still recording.
Okay, I'm sorry.
Let's put that in the bloopers. So thanks. Thank you, Rob, for being our guest today. Sarah will definitely put in the show notes how people can reach out to you if they wish to, pursue any other advice, tips, tricks. Thank you again. We wish you and your company much success in the future. Please like, share, and subscribe, everyone, to our YouTube channel, and we will see you on the next episode. See ya. Bye.
Thank you. Bye-bye, guys.